so what I'm going to be talking about today is the corporate side of property insurance. The basic theory behind property insurance, which can also be the theory for any other insurance, is that the owner of a piece of property who has insurable interests, such as a home for example, will pay a premium to an insurer to safeguard this property from a covered risk. In the event of a loss, the insurer would pay out on the claim. Now, if no claim has been submitted, the insurer will keep the premium. Now, in property insurance, this is an aleatory contract, which means the values exchanged are unequal. So, for example, if the insured pays a premium of $1,000 and the insurer pays out $1 million, the values that were exchanged were unequal. Next slide, please. Evaluating risk and developing premiums. Well, this all starts with an underwriter, which would be the key person evaluating risk and determining premiums. Insurance underwriters evaluate the risk and exposures of potential clients. They decide how much coverage the client should receive, how much they should pay for it, or whether even to accept the risk and insure them. For property insurance, there are three key underwriting considerations: location of the premises, the type of construction, and the values associated with the covered property. A tenant-occupied property is considered a higher risk and issue higher premiums because insurance carriers assume that tenants don't maintain the house as well as others owners would. Once the risk is evaluated and the premiums collected, the insurance company will insure the property and pay out the claim. Next slide, please. Use of premium and profit. Just like any other company, one of the many goals of insurance companies is to make a profit. So for example, if an insurance company says to a person, if you give me $1,000 and your house burns down tomorrow, and I will build you another home, as a result, this person agrees and pays the insurance company. That is considered insurance. An insurance company will make money because they evaluate the risk and decide whether the risk is worth the gamble. From the insurance company's perspective, the company believes that there is a high probability that the policyholder will not incur a loss on his property, and therefore the company will keep the premium and make $1,000. What the company will then do is they would insure, let's say, 1,000 more people, which all pay $1,000 as well to insure their homes. Now, if they insured 1,000 people and they all paid $1,000, what the company would make is $1 million in premium. Now, let's say one of these people out of 1,000 decides to make a claim totaling $200,000. What will remain is $800,000, so the company would keep $800,000. Essentially, what the insurance company is doing is taking premium or payments from a large group of people and holding it in one place. Then once a loss occurs, it will pay out. However, it will have pooled money that is in excess of the loss, and therefore will keep whatever is left over. Today, insurance companies are largely competitive, which brings in more business the insurance company and is good for the client because there are competitive prices. Companies look to write as many policies as they can so that they can create a financial pool. Next slide, please. Additional uses of premium. Now, what happens if an insurer pays out more than they make in policy premiums? A lot of people may have wondered, so for example, if they collected $1 million in premium and they pay out $1,200,000 in premium, well, then they will be at a loss. How would they make money? In most cases, people would think that they would become insolvent, be unable to pay claims, and therefore go bankrupt. But what they do is they invest the premiums in high interest investments. They make money outside of the insurance product. Insurance is just a form of cash flow for the company to invest in more lucrative investments. They invest the premiums in stocks, bonds, and other interest-bearing accounts. From this investment income, an insurance company can pay claims, commissions, and administrative costs while otherwise financing its operation. When the market does poorly, insurance companies take a hit. However, they should have enough income and reserves to cover their claims. Next slide, please. So in conclusion, unlike government insurance, private insurance companies are there to make a profit. It is a business like any other. Thank you.